utilizing sensitivity analysis as a tool for risk integration in capital budgeting. Introduction. Sensitivity analysis is an analysis of the sensitivity of an output variable and putting that output toward input variable changes, and is well known as a capital budgeting tool. Furthermore, sensitivity analysis also often focuses on changes in just one variable and not overall scenarios. And sensitivity analysis is also utilized to reduce and prevent risks, analyze quantitative and qualitative marketing factors, and make efficient decisions that allow shareholder values to be maximized. Finally, sensitivity analysis allows the examination of the sensitivity of income output and changes in the input of sales and costs within capital budgeting. This presentation will present important quantitative and qualitative factors, methods, and techniques utilized for risk integration in capital budgeting. Important goals and functions of financial management for risk integration in capital budgeting. 1. Primary goals. Maximize the shareholder's wealth. Maximize the price of stock. 2. Core functions. Decisions for investments. Determining and choosing important projects for capital budgeting. Financial decisions. Providing efficient financing for capital structure. Risk management. Minimizing and preventing adverse impacts. Determining how sensitive a project will be to risks. Important quantitative steps in sensitivity analysis for risk integration in capital budgeting. Prepare base cases. Develop detailed cash flow forecasts for expected sales and operating costs. Identify the variables. Allocate key sales volumes, input costs, and interest rates. Set the ranges. Identify the optimistic and pessimistic values in sales and employee gross profits. Calculate the impact. Calculate changes with the NPV function for each time value of money scenario. Important qualitative steps in sensitivity analysis for risk integration in capital budgeting. Identify problems. Identify and determine objectives in sales, volume, price, and cost variables. Management decisions. Gather data and predict and evaluate possible scenarios that are extreme. Identify the needed model. Identify and establish a financial model, such as the capital asset pricing model, to utilize for evaluating system sensitivity for variables and set ranges and market risk. Analyze the results. Review the variables in results that have a high impact on NPV and internal rate of return, IRR, over time and assess project vulnerability. Important internal risk assessment methods for risk integration in capital budgeting. Scenario analysis. Evaluate the outcomes of projects with base case, optimistic, and pessimistic beliefs in order to provide data on potential outcomes. Weighted average cost of capital, WACC. Utilize the WACC for taking on higher risks with higher returns and to prevent such risks and stabilize costs and financial leverage in financing. Expected value method, EVM. Utilize the expected value method to convert risks into single values, thoroughly examine ranges of data, and define gains and losses in capital projects. Important external risk assessment methods for risk integration in capital budgeting. Scenario analysis. Utilize scenario analysis to reveal best case, worst case, and base case scenarios for assessing drastic market changes. Least squares method, LSM. Utilize the LSM to accompany the scatter plots of regression analysis to quantify, model, and predict risks, financial losses, and capital budgeting requirements. Percent of sales method, PSM. Utilize PSM to calculate future assets, liabilities, and costs to determine needed external financing and to prevent the risk of overinvesting in the capital budget. Conclusion. The author has concluded that utilizing sensitivity analysis as a tool for capital budgeting is one of the best tools that businesses can utilize for ensuring that their capital budget is as efficient as possible. Furthermore, the author now firmly believes that utilizing quantitative and qualitative methods with sensitivity analysis to integrate internal and external risks allows for very efficient capital budgeting decisions. Additionally, qualitative and quantitative factors utilized to integrate risk are essential in management, ensuring maximized returns. Finally, it is clear that all of the elements combined in this presentation are the most efficient approach for transforming forecasts that are uncertain into risk-aware and risk prevention decisions in businesses. Lastly, all of the elements combined in this presentation greatly help business projects be successful and help empower the main goal of maximizing shareholders' wealth.